Imagine looking at decades of chaotic market data and finding the hidden mathematical patterns. Instead of guessing where a stock might go, you build a system that finds the signal in the noise, snapping into focus to point toward what happens next. In quantitative finance, we call this kind of prediction engine an alpha. An alpha is a mathematical model designed to forecast the future price movement of various financial instruments. Over the next few minutes, we are going to build and simulate a working alpha from scratch. We will base our model on a straightforward contrarian strategy known as price reversion. As long as you have access to the simulation platform, you have the ability to take raw, everyday market data and turn it into a highly predictive financial tool. Let's look at the data we need to start. Step 1 is identifying our base data. For this model, we are going to use a data field called returns. This diagram shows how we organize the data. We have stock tickers on the vertical axis and dates on the horizontal axis. Returns simply measure the percentage a stock's price changed compared to the previous trading day. When the raw data copulates the grid, we get a detailed historical record. Every cell contains the exact positive or negative percentage movement for a specific company on a specific day. Looking at this grid right now, it tells us exactly which companies gained value and which lost value yesterday. But that is strictly historical fact. To build an alpha, we need to take this record of past events and use it as the raw material to forecast tomorrow's movements. This brings us to the core of our strategy. We are going to bet entirely against yesterday's market movements. To do this, we apply a mathematical operator. In this case, simply placing a minus sign directly in front of the returns data field. Mechanically, this minus sign inverts the historical data. Every positive green number becomes negative, and every negative lead number becomes positive. This represents the first half of our predictive theory. If a company had unusually high returns yesterday, our inverted model predicts its price will decrease today, and the inverse is also true. If a company suffered low or negative returns yesterday, the model predicts its price will increase today. Investing opposite to company returns like this is a specific strategy we call price reversion. Price reversion operates on the basic assumption that markets tend to overreact. By mathematically flipping the past data, we position ourselves to profit when the prices correct themselves. Right now, our inverted returns are mathematically correct, but the values are far too scattered and messy for a simulation system to process efficiently. To clean up the predictions, we need to introduce a formatting tool called the rank operator. This chart shows the first function of the rank operator. It takes all the chaotic input values across our dataset and sorts them neatly from highest to lowest. Next, the rank operator takes that sorted list and spaces the values out at perfectly even intervals. This process neutralizes extreme statistical outliers that could throw off the model. When you write this out, pay close attention to the syntax. The minus sign must go inside the parentheses, giving us the exact expression: rank, open parentheses, minus returns, close parentheses. Applying the rank operator does not alter the underlying price reversion strategy. It simply standardizes the data so the mathematical model can function without errors. Now that we have our logic and formatting, open your simulation platform interface and locate the expression input bar. Carefully type the exact formula into the system: rank, open parentheses, minus returns, close parentheses. Take a second to verify your syntax. Ensure there are no spaces and the minus sign is correctly placed. Once confirmed, click the Simulate button to initiate the backtest. The system is now testing your price reversion theory against massive volumes of historical market data to see if the strategy holds up. The historical simulation is complete, and the system has populated the results on your screen. This graph shows the outcome of our strategy. Notice the positive performance curve tracking upward over time. This confirms that betting against yesterday's returns generates a reliable profit in this test environment. Hugh just successfully built and simulated a working quantitative trading model from scratch. By combining a negative operator to capture the price reversion strategy and the rank operator to cleanly format the data, you now know how to build the fundamental blocks of a true alpha.